Good afternoon, traders and investors. Will back here with another one, coming to you with a Sunday video, guys. And it's that time of the week again where we go over the top 5 options plays for the upcoming week. Now, keep in mind that this is probably going to be the biggest week of the entire remainder of the year. And for two very simple reasons. This is a week of everything and the kitchen sink. We have a ton of very important macro news releases. GDP numbers on the Wednesday session. Thereafter, core PCE numbers in terms of inflation on the Thursday session. And Friday, they're going to hit us with the jobs report, the non-farm payrolls. All three of these things can on their own move the markets in a substantial fashion. Thereafter, we have catalyst number 2, which is just the sheer amount and size of the earnings that we have over the course of the week. Several very large names are reporting. AMD, Alphabet, PayPal, McDonald's, Visa on the Tuesday session. On the Wednesday, major healthcare player Eli Lilly, Caterpillar, Microsoft, Meta, Coinbase, Robinhood, a ton more. And on Thursday, Uber, Amazon, Apple, and MasterCard as well down there, and so many more in between. So this week definitely has the potential to move the market in a very big fashion in either direction, depending on the results of the macroeconomic news and also depending on the results of big tech. The QQQs are supposed to move approximately 2.1% up or down this week, so it definitely will be an extremely volatile week. So, in terms of what we're going to do in today's video, guys, number one, we're going to set the context for the week, look at the technicals, look at these economic factors, and kind of get a sense of where we could possibly pull back in the event that things do not go in the bulls' favor. Number two, we're going to take a look at the top 5 options plays for the upcoming week. Keep in mind that all of them are going to be for selling put options, more specifically as part of the larger wheel strategy that we like to run on the channel. So I'll give you guys the top 5 options plays that don't have anything to do with earnings at all, and those are just going to be the regular plays for the week. Thereafter, in terms of bonus plays, I will tell you how we can possibly play these earnings in the safest way possible in the event that you have high conviction companies that you would like to possibly enter a position on before earnings. Not financial advice, of course. I will let you know the strategy that I prefer to do when we're looking to write options and benefit from some of this volatility prior to earnings. And then lastly, I'll also do something that I don't do very often in this option series. I will be giving you a few leap call option strategies that I'll be looking for some of my favorite companies in the event we have some drops after earnings. I'll let you know which ones could be possibly very interesting for some leap call options on my favorite companies. So a lot to cover in today's video, guys. It should be a very juicy one and a very interesting week. Just be careful out there. Do not chase the market to the upside. We can make a lot of money this week if we play the strategies correctly, but you can also lose a lot of the money if you get too greedy and start chasing things, and then you end up getting hit with a bad macro catalyst or getting hit with a bad earnings catalyst as well. So in terms of the context of the week, guys, well, obviously I mentioned the sheer amount of macro data reports that were coming out. We know that the context right now is the market is kind of teetering between the no recession narrative and the recession narrative. If this GDP number comes in weak on the Wednesday session, that is a point in the favor of the recession case scenario for the markets. Now, in the event it's close, like a 2.8, the expectation is 3, I wouldn't expect too much of a big deal for the markets. But if it comes in way lower than expected, that is going to move us in a negative fashion. Thursday inflation. Inflation has been on a downtrend, but there is this worry about possible sticky inflation rearing its ugly head once again. If this inflation report comes in way hotter than expected, this will be another catalyst towards the markets coming down. And lastly, on Friday, we know that the big focus, especially in terms of a recession scenario, is the jobs market. So in the event we come in well below the expectation of 140,000 jobs for your non-farm payrolls, expect the markets to get hit quite hard to the downside as well. Now, in terms of where we stand on our technical analysis portion of the video, well, the bulls are still relatively in control. We know that on the SPY, they did lose the daily uptrend. We are setting up possibly for a daily downtrend continuation. If these macro events are bad, if earnings are bad as well, that will carry the SPY further to the downside. But the context is the weekly bulls are in full control. We have tons of space, guys, if the markets start pulling back, but This week, we could possibly pull back into the next area of support on SPY, which is 565 down to 560. If all of those catalysts end up pushing us to the downside, I would not be surprised if we end up with a 2 to 3% week to the downside into that support zone. And QQQ, same exact thing. We know the bulls have the weekly uptrend, but if these catalysts come out negative, guys, I would not be surprised if we have a 2-3% week down on the QQQs, pushing us down into the level of support 480 down to about 475. So we have a lot of space to work with, but the last thing that you want is to get trapped near the all-time highs on these markets, and then we go into big weekly consolidation for 1, 2, 3 possible weeks. You're trapped all the way up here. You have no money to buy the dip down here. That is the last thing that we want. So I will reiterate, do not get too greedy this week of trading. Let the market come to you, guys. It's the most important thing that we can do as traders, trying to, cycle through these catalysts as a whole. Now, in terms of the strategy rules that I'll be looking for here, guys, in terms of selling puts, right? So I'll go through these very, very quickly because I want to put a lot of emphasis on the trading this week. But in terms of selling puts, right, for the top 5 options plays for the week, well, I'll go through the rules quickly. If you have not seen my 30-minute video on the detailed version of this strategy, I'll leave it down below in the video description. It goes through how I pick my stocks, how I pick my strikes, and just a more detailed view of the strategy. But as of right now, let's go through these rules very quickly. So number 1 rule, solid companies only. But since we're writing puts, guys, we have the risk of being assigned the shares. So you only want to be assigned shares in a very, very, very solid company. If it's not a solid company and you get assigned and you end up with a loss, you'll be wondering, what am I even doing in this stock in the first place? I got seduced by the premium and now I'm trapped. So just do not do it. It needs to be high conviction stocks only. Number 2, we want to look for stocks at a monthly uptrend or a long-term range just to get better odds behind us, right? So a long-term monthly uptrend could be something like this on Microsoft, right? And when we're playing a shorter term, long-term range, the area to write the short puts could be down here in the lower support zone, about 405 to 400. So we're looking for large support areas on the weekly, but still being in a nice monthly uptrend. So hopefully that makes sense for point number 2. Now, in terms of point number 3, we'll be looking for companies that have no earnings this week, guys. We do not want to write puts on companies before their earnings. Writing them after earnings is perfectly fine, but before always carries some risk. You guys know it best, right? Earnings sometimes can be an absolute casino. You can be expecting a 5% move up or down, and the stock can move down 10, 15, 20%. So to be safe, just do not write any puts with companies that have earnings this week unless it's after the earnings actually come out. Number 4, we want to be targeting stocks in a support area or an area of breakout retest. I'll use the Autodesk example for this one. So a support area is very simple, guys. You see this 2 years worth of support. Usually writing puts in such large areas of support can be a favorable trade. Now the breakout retest trade is something like this. We have a higher end of resistance right here. We break it out to the upside, retest, and then run. This little retest area is usually a very high probability trade when we break out of such a long-term range. So it's either going to be one of 2 scenarios for me, writing at support or finding breakout retest area trades to run. Those are the only types of trades that I will showcase on the channel for the usual put wheel strategy. Now, number 4 and number 5, number 5 and number 6, they kind of go hand in hand. We want to be writing stocks at or lower than the expected move. If you do not know what the expected move is for a stock, you can go to this website right here, optionsai.com. And let's say we were looking for, well, Google's a bad example because they have earnings this week. Let's say we look for Square, right? Square has an expected move of 5%, 5.3% up or down. We always want to be targeting to write below the expected move, guys. We're just trying to benefit from a little bit of mean reversion. If Square comes down early on in the week, close to the expected move, we can write options at strikes below the expected move. It improves our probabilities of not being assigned, because if it comes down too quickly into or beyond the expected move earlier on in the week, we can expect a little bit of mean reversion, which pushes us back into the expected move midway through the week. And now, writing on a red or flat day, this carries into the previous point, right? If we're looking to write stocks close to the expected move or below, well, it stands to argue that we need to be writing on red days, right? The last thing you want to do is have a stock that's 2-3% up and chase it to the upside. We want to be focusing on stocks that are red because it gives us an opportunity to go below the expected move. Hopefully that makes sense. Now, before last, we're looking for stocks. This is the ROI. We want to be writing between 0.5% and 0.75% in weekly premium. What does that mean? That is how much money we make on the trade. So the 0.5% rule is very, very simple. What we're looking for here, guys, is half of the strike price in cent increments, right? So you see the 68 put. Let's say I want to buy Square down here at $68 with some short puts, right? So we take a look at Square. We can see that the expected move for the week is 68.75. If we want to write, let's say below that, the $68 strike into this area of previous resistance, which should now be support with all the moving averages right there, well, we'll be looking at the $68 strike because it fits our technical criteria. How do we know if it's paying us enough money for that trade? That is where the 0.5% rule comes in, guys. 0.5%, very, very simply, watch, right? If we do 0.33 divided by 68, that gives us roughly 0.5%. So that is how you know that this respects the ROI criteria. Why I chose the 0.5% rule, guys, is because in my experience trading this strategy for the last 5-6 years at this point, it usually provides the best trade-off between weekly ROI and risk of assignment. You still make decent money. The risk of assignment is quite low. So that's why I like the 0.5% rule. Once again, if you want to go through a ton of options chain really quickly in your head without the calculator, just look for half of the strike price in cent increments. It'll always be 0.5%, right? So if you want to, that's roughly 0.5%. Let's say you go for the 66s and you want to see 0.5%, it should be 33 cents, guys, right? 0.33 divided by 66 is literally 0.5%. So that's how, with just very quick mental math, you can go through a ton of these options chains on many different stocks very, very quickly. Lastly, we want to set a take profit order at 90% of the contract value. If you get a very good entry on Monday or Tuesday, guys, and then Tuesday afternoon or Wednesday, the stock moves up, well, you don't want to be caught in that trade. If you're already 90% profitable on the trade, you may as well just close it and look for another opportunity, right? That's why we set the take profit order. And in the event we get assigned the shares, we have to buy the shares at the strike, we will be looking to write covered calls. This is where the second aspect of the wheel strategy comes in. Writing puts is a way to get into a stock. Selling covered calls is the way to get out of a stock if ever we're assigned. So we want to be respecting the same rule in premium here, 0.5% to 1% in weekly premium for the covered calls. And lastly, we want to be writing at the assigned strike price or one strike higher. So let's say on Square, if ever Square ends up on, let's say we write the 68s and Square closes at 67 on the Friday, we have to buy the shares. The following Monday, what we do is we will write the covered calls at the $68 strike, provided it gives us the correct ROI. Now, the only time I will choose to write one strike price above where I got assigned is if on the Monday session, Square has a gap up open, we run 3-4%, then I'll probably write 1 or 2 strikes higher, just trying to capitalize on that share appreciation. So that is pretty much the gist of the strategy. Hopefully all of that makes sense. Now let's jump into the juicy stuff, guys, which is going to be the plays for the week. So first things first, let's go through the regular top 5. No earnings risk whatsoever on the names that I'm about to give you. So if you're conservative and you don't want to go through all of these massive catalysts right here, here's the ones that I could possibly be looking at for the week. So number 1, very defensive stock, it is going to be Coca-Cola. So Coca-Cola is coming down right now and is respecting one of my favorite trades, the good old breakout, retest of the prior range of resistance, which was the prior all-time highs. This is the monthly time frame, right? Breakout, retest, and possibly good for another leg. So Coca-Cola is coming down into this area quite aggressively, as you can see, and they are daily oversold. Coca-Cola is a stock that does not get daily oversold that often. As a matter of fact, the last time it was last October when they really fell off a cliff. But other than that, these are more favorable market conditions, and Coca-Cola should be benefiting from a little bit of a bounce soon. So the expected move on Coca-Cola is 65.89. And what do we have down below here, guys? This green line is the 200-day moving average. So I'll be looking for some short put opportunities in or around those strikes. So let's have a look at Coca-Cola and see if we can find anything juicy below the expected move that respects our ROI criteria. So let's go have a look right here on the options chain. And as we can see, we're looking for 66, a little bit aggressive, or 65 potentially. Let's have a look right here. As you can see, the $66 strike, it is not paying enough. Half of 66 is 33. We do not have the 0.5% rule just yet. So we need Coca-Cola to drop a tiny little bit, guys. If they drop a little bit more, this should free up the $66 strike. However, if on the Monday session, we have a minus 2% day and we come below the expected move right away, then we will be obviously looking for the $65 strike. The best thing you can do with this strategy, guys, is be dynamic on the strikes. You want to see what happens to the stock on Monday or Tuesday, and then depending on the size of the drop, you adjust your strikes lower and lower. The art of this strategy, guys, is to be able to pick up the lowest possible strike while still getting our 0.5% premium in ROI. So be dynamic with it. For me, it's either the 66 or the 65 strikes for this week on Coca-Cola. That's play number one. Play number two, we just kind of looked over it a little bit. It is going to be Square. So Square, the reason that I like it, guys, is because it's also doing a little bit of the breakout retest pattern. We have a nice weekly uptrend here by the bulls. We're above all of our weekly moving averages, as you can see. If we pull back a little bit more, I'm expecting this whole prior area to act as some support, right? It was resistance in the past, should be acting as support. The moving averages are there as confluence. So it could be a very, very interesting trade. And the only catalyst that can maybe derail this trade this week is PayPal earnings on Tuesday morning. Usually Square doesn't move that much in line with PayPal, but it is the closest thing that we have to a potential catalyst for this stock. So the expected move is 68.75, literally right into the area that we want. So let's have a look on Square options and see what we can find in or around that expected move. So taking a look at the options chain real quick, let's go have a look. Can we find anything below 69, let's call it, right? Well, fact of the matter is 68s are paying roughly 33 cents. Not quite 34 cents, which is exactly 0.5%, but close enough to where I wouldn't mind it. However, if Square continues having a little bit of a dip on the Monday or Tuesday session, we come down into the 71s, $70 strike, then you can probably find even lower. Think the 67s, think maybe even the $66 strike. So at a first glance, depending on the size of the move down Monday or Tuesday, and obviously guys, if the stock just moves up, are we going to chase this and start writing above the expected move? No, we do not chase to the upside, guys, trying to write higher and higher. We want the move to come down into us so we can write lower and lower. It reduces our chances of being assigned. So for me, at a first glance, depending on the size of the move, guys, I'll be looking for either 68, 67, or 66. Now, let's say Square has a minus 4% day on the Monday and comes super close. Are we still going to be writing super close, guys? No, you want to go even lower. Think the 65s or the 64s. Be dynamic with it. Read the options chain and find the lowest possible strike for the 0.5% rule. As long as we're below the expected move and into this very nice choppy area of support, we should be good for this trade. Now, option number 3 is going to be Chewy. Chewy as well is not affected much by these earnings this week. They only have earnings coming up in about a month and a half of time. So Chewy, nice little area of support right here, talking about 26.50 down to about 24. So this is kind of the range that I like to play for this stock. Have some long-standing areas of support back here, coming from all the way back in June. And the monthly bulls, as of right now, do appear to be somewhat in control of this chart. So I like it. It's a cheaper options play for the small accounts. So that's why I kind of like playing it. So the expected move is 25.69. Let's go see on Chewy. Can we find any premium below the expected move of 25.69? And I have it right here. So let me just pull it right up. So Chewy, as a matter of fact, you can see right here that if we're looking for below 25.69, we have to go either for the 25.50s or the 25s. Now, as you can see right here, 25.50 has over 0.5%. Half of 25.50 is roughly 13 cents, right? So at this point, it's going to be well above our required premium. So for me this week, it's either going to be the 25.50s or the 25s. If Chewy has a little bit more drop on the Monday or Tuesday session, we can probably even find some good premium at the 25s or the 24.50s. So 25.50 all the way down to roughly 24 is my desired range to possibly be writing some Chewy put options. So hopefully that trade makes sense as well. Now, stock number 4 is going to be Barrick Gold. So we know that gold has been going on a crazy rally recently, but one of the miners that has not really benefited from this rally is Barrick Gold. That being said, they're coming into a very nice area of prior support, guys, right? Look at all of this support below us. This is pretty much a breakout retest trade on a monthly time frame. Nice monthly uptrend, pulling back, looking for a possible leg higher. All of this area, I mean, this was support, this was prior resistance. This is a monthly chart, guys, right? So now we're coming into this lower zone, which is support once again. And we have the monthly moving averages right below us at about 18. So the expected move for the week is 18.92. Let's go shopping on Barrick Gold to see if we can find any premium below that strike of 18.92, right? So moving into it, as you can see, there is some premium here at the $19 strike. It is slightly above the expected move, but not too much. So that's a bit more of an aggressive play if you're willing to take Barrick at 19. I wouldn't be opposed to it just because it's a relatively conservative play and we're into a very large area of the monthly support, right? So I wouldn't mind the 19s, but the one I would really prefer would be the 18.5s. In the event Barrick Gold here has another continuation of the drop here into the Monday or Tuesday session, and we pull down into the lower 19s, higher 18s into the expected move, that is going to free up the 18.5s, which is my desired strike. So for me this week, it's going to be one of these two, 19s or 18.5s for Barrick Gold. Hopefully that trade makes sense as well. And lastly, another one that is quite juicy, but a little bit more risky is going to be BITX. This is the 2 times leverage Bitcoin ETF, right? And we're looking at Bitcoin. So all the analysis for this trade needs to be done on the mother pair, which is Bitcoin right here. So as the context of Bitcoin right now, we know that we have a nice weekly uptrend underway. They set the weekly higher lows last week at about 65,000, and we might be looking for a new leg to push higher into the above resistance. However, if we start getting rejected and move a bit lower, guys, and set up the daily downtrend, go into a bit more weekly consolidation, well, I'll be looking to play a little bit more of BITX. So BITX, the area that we're going to be targeting, guys, for that move down is going to be below the expected move of 28.92. I would really like to get down here in the lower 27s because that is synonymous with Bitcoin being around 64,000, which is all the way down here. And I would not mind buying Bitcoin in the event we fall that much. So BITX expected move 28.92. Let's go have shopping and you'll see, guys, these options are extremely, extremely juicy. However, do not get seduced by writing premium too close to the current market. As you can see, the $30 puts right now, which are very close to BITX's current price, right? The 30s are paying $1.35, guys. That is huge, huge, huge premium. Look at the ROI on these. 135 divided by 30, right? You're getting 4.5% for a single week. That is literally like 9 times what we usually try and get on these short puts. So do not get too greedy with BITX. Do not get seduced by the premium. This one can move excessively fast if Bitcoin comes down. So we want to be going a little bit more conservative. And you'll see even the conservative areas, guys, pay a lot of money, right? So let's expand this options chain real quick and I'll show you what I mean, right? So if the expected move here is 28.92, let's go below it and see how far we can go down while still getting paid decently for it. Even the 27s, where I actually want this one, are paying 34 cents, which is well above our 0.5%, guys. 34 cents divided by 25 is 1.3%. Twice, almost 2.5 times what we're looking for on a weekly basis. So if you're more conservative, you can go with the 27s, 2650s, even the 26s are paying almost 1%. So the art of playing this one correctly, if you're conservative, is playing the more conservative strikes down here while still getting paid a handsome amount for it. Obviously, if you're more aggressive and you have a very bullish view on Bitcoin, I am not here to tell you what to do. You can write the more aggressive strikes if you want to. Just be careful in terms of your sizing, guys. You do not want to get trapped with a huge position up here at 30, and then we come back all the way to 28, 27. You're down a lot of money. I understand the covered calls are juicy as well. Just please be careful if you are playing this trade. So that is pretty much the top 5 options plays for this upcoming week that don't really have anything to do with earnings. Now, let's get into the bonus plays, okay? So I'll show you guys. Number one, what we're going to do is I'm going to save a lot of buying power. We're going to do this earnings plays 2 different ways. Number one, I'm going to show you guys how to be patient with earnings, how to write puts after earnings to respect our criteria, right? We want to be targeting large areas of support. Here are the plays for earnings that I will be looking to play after they happen. I'll give you guys the strategy after this. I'll tell you guys how we can play them before they happen, but here's how I'll do it after they happen, right? We'll take a look at a few different names. So if you want to screenshot, these are all the names that I will be highly interested in playing after earnings and possibly even before earnings as well, okay? So here is the list now with some examples. So let's go with ON Semiconductor first. This is going to be for an after earnings play, right? So let's say ON Semiconductor, guys, after earnings comes down, you know, 5, 6, 7, 8%, right? At that point in time, we want to be targeting a lower area of huge weekly support, right? So in ON Semiconductor's case, this would be the lower $60 range. If we come down early on in the week after earnings tomorrow morning, and we come down 5, 6, 7%, you will find some extremely juicy premiums down here, guys, but you have to be relatively quick with it in the early portion of the morning while volatility is still high. Another example I'll be looking at is Google, right? So Google is one that I'll be highly interested in the event they come out with bad earnings, right? Let's say the stock moves down and we end up with bad earnings. They have earnings on the Tuesday after the close. So Wednesday morning, when we look at our charts, if Google is down here, close to a very big area of weekly support, right? Weekly support could be 152 down to about 143. It's the previous area of the all-time highs. It's where we got rejected back here as well. Congestion here. So this is the desired area for Google for me. If we come down 4, 5, 6%, something like this, 156, I'll be looking to write some puts down here, guys, 152, 150. And for these overall areas of support, guys, if you don't know how to draw them, just be very lenient with them, right? They don't need to be exactly to the penny, exactly to the dollar, right? If I'm looking at Robinhood right here, you know, I don't have a recent area, but Robinhood has earnings coming up on the Wednesday after the close, right? So to identify an area, guys, you just have to include most of the price action, right? We see the resistance up here, so we grab these guys. You see these guys acting as a little bit of resistance here as well. So this is the general area that we're looking for, right? If Robinhood pulls down into this area, we know that the context at that point will be looking for the continuation of a monthly uptrend, a little bit of a pullback, and possibly run. So when we're looking at our weekly levels, this is the major weekly level. You can see it best, right? Big resistance, congestion here, the 12 EMA. Okay, perfect. I have a nice level. If Robinhood drops 5, 6, 7% after earnings, that will open up some decent strikes in our big support zone. So we can go through the remainder of the list, but all of it is going to be the same. Let's take, for example, AMD, right? So let's say we want to play some short puts after AMD earnings. If they fall, we'll take a look. Where is the larger area of support below us? Well, I've identified it right here, and it's actually the 142 down to about 130 level, right? Prior resistance here, a little bit of a back test right here, big area of support back here. So if AMD falls into the Monday session, or the Tuesday and the Wednesday session, we come down 6, 7%, there's probably going to be some decent premium in the big area of support down here, guys. 140 down to 135. As per usual, we want to be going as low as we can possibly go. And I'm not opposed to writing some longer dated short puts as well. I know I always give you guys the weekly time frames, but if it's a high conviction stock for you and you really like the stock price, guys, you can go out with a lot more time, right? We can always do, 30, 45 days short puts if you really like the level. Just remember to respect the criteria. If you're writing 4, 5, 6 weeks out, you want to at least get as close as possible to 0.5% per week, right? So if it's paying you, 3%, let's say, for 6 weeks, that would be roughly 0.5% per week. So it would respect the criteria. So I'm not opposed, once again, if Google comes down into the major area of support, and I like this one, and I'm nervous that it may just come into here briefly and then pop out, and I want to get as much premium down here as possible while it's there, you can choose to write options after earnings that have 30, 45, even 60 days worth of time on them, provided they're respecting your rules, right? So that is how we're going to be looking to play earnings after they happen. Identify the larger areas of support on high conviction stocks, guys. Only high conviction stocks, right? Identify the larger areas of support, and then you can go shopping for earnings in the event they drop into it, right? So hopefully that makes sense for playing earnings after they actually occur, right? You can do it on a weekly basis, or as I said, you can write the longer dated puts 30, 45, 60 days out. Just make sure you get paid adequately for it, right? It serves me no purpose if Google comes down here 155 and I'm going to try to write 45-day puts for 140, right? It's too far away. You'll maybe only get, 0.2, 0.1% per week. The ROI is not worth it for the capital deployed, guys. So for the longer dated puts, you may not get 0.5%. You may get 0.4% per week. That is perfectly fine. Just try to stay close to our ROI targets, all right? So hopefully that makes sense. Now, Now, bonus plays number 2. How do we play these before earnings, right? So this is going to be the key to playing these before earnings. Now, I'm not recommending anyways, none of this is financial advice anyways, right? But I can never recommend anybody play these things prior to the earnings because we know how extremely volatile earnings can be, right? However, if you are willing to play these opportunities prior to their earnings and take your chances, because we know that premium on earnings weeks are usually quite juicy. The only strategy that I ever use if we're looking to write puts under the market is called the 2 times the expected move strategy. Essentially what it means is you see the expected move here for Google, it's 6%. So I want to go 2 standard deviations away, aka 2 times the expected move. Now, the moral of this, or the crux of the strategy rather, is you have to wait for the day before earnings because this expected move, guys, is going to move from the Monday to the Tuesday to the Wednesday. The stock price is going to move and these numbers are going to be different, right? So what you want to do is the afternoon prior to earnings. We're going to use Google as an example right here. The afternoon prior to earnings, 3 p.m., 3:30 p.m., before the market closes, when the volatility tends to go up and people start loading into the options, right? What you want to go to this page and see the expected move. Let's say for a theoretical purpose of example that we are Tuesday right now and it is 3:30 and this is the expected move. Well, you look 6% the expected move, which is roughly, let's call it 167 down to 157, right? That's about $10. So we want to be going $20 away from Google's current price. So let's go shopping for some Google options prior to the earnings, right? So I have GOG up here. So let's go shopping for Google and I'll show you guys which ones that I would like, right? And in terms of the 0.5% rule, you're probably not going to get it. It's just we get whatever we can get so long as it's worth it for us. Let me show you what I mean, right? So let's go $20 away from Google's current price, which is roughly 167 right now, right? So as we can see, we want to be going probably closer to the 147s at this point in time, right? So as you can see right here, we're now $20 away. We are 2 times the expected move away from the current stock price, Google, and we also want to line this up with a large area of weekly support, guys. If we measure 2 times the expected move, and we are not at an area of big support, I will not take the trade, guys. So number 1, 2 times the expected move. And number 2, that 2 times the expected move has to be in a big area of weekly support, guys, because you need somebody to be there to play defense if we come down hard into it, right? So as we can see, 147 for Google is right within that area. And it is very far away, right? You're talking about a 12% move down on Google. And at that point in time, guys, we can capture some of this volatility. You can see the 147s pay 0.4. Now, it's not 0.5%, but it's not meant to be, right? 2 times the expected move is a long way away. Very rarely will you get compensated with 0.5%, right? So 0.4 divided by 147, you can see right here, it is only 0.027%. Not that bad in my humble opinion, guys. It's really not that bad at all. And if we go into this one, if you want the extended calculation, right, you can go into 0.4 divided by 147 times, and this is your ROI per year, okay? So times 365 divided by your days to expiry. We measure how many days are left after Google earnings. You'll be here. So this will be 1, 2, 3 days to expiry. So you divide this by 3. And that'll be about 33% annualized ROI. I want to see above 30% annualized ROI for these trades. That's how you know they hit the minimums for the 2 standard deviation move away, right? So once again, the calculation is as follows. You take the premium right here, right? So 40 at the 147s, 0.4 divided by 147. That's your weekly premium. We time this by 365, which is the amount of days in a year, and then we divide it by the days to expiry. It lets us know for the week on a relative annualized basis, how much money are we making if we were to take this trade every single week moving forward, okay? Hopefully that makes sense. It is 33%. We want to be above 30% annualized for the trade to make sense for us. So hopefully that makes sense, guys. So once again, I'll recap the rules because I know I just threw a lot at you. You're looking for 2 times the expected move. You're looking into a big weekly area of support, and you're looking for 30% annualized ROI to respect your trade minimum. So hopefully that makes sense. If you want, I'll throw one more example at it for you guys, just so the trade makes sense, right? So let's just say, somewhat of a cheaper one, right? Let's take, Uber is okay. We can possibly do Uber, but Uber is a little bit high right now. Let's say Amazon, right? All right. So Amazon is kind of at the highs right now, but we'll do it because it's a high conviction stock for me. And if it drops into the 175 area, that's where I want to play this one, right? So we can see that the whole 175 is the start of a very large area of support. If you don't know what this area is, guys, it's all the people back in 2020 and 2021. So if the bears come down into this hard, all these guys are going to be playing big defense for us, and all the recent guys down here are also going to be playing defense for us. So the expected move for Amazon for the week, let's just see. Let's say it's right before earnings, right? Let's say it's, Thursday. It's going to be after the close, so Friday. So this will be for the following week thereafter, guys, right? So I'll give this on a theoretical example purpose, but Amazon is towards the later end of the week. So, I mean, it's going to be tough to write puts for the Friday expiry, right? You're going to have to probably go 1 week into the future. So maybe Amazon's a bad example right here. Should have thought of that moving into it. But, we can do the theoretical example for maybe 1 week in the future, right? So let's say Amazon, the expected move for the week is 6.3%. Roughly 187 down to about 176. So let's call it about $11, right? So we multiply that by 2. Now 2 times the expected move is $22. So $22 away from this will be roughly, let's call it 165, right? So where is 165? 165 is in the lower area of our weekly support. So perfect. We know that the criteria is met. Now let's go shopping for some Amazon, shall we? So let's say, now this is going to be the options for this week, of course, but Amazon's reporting on the Thursday. So when we look at these, we'll have to look for the following week, right? Not November 1st. We'll have to look at November 8th, but the logic will be the exact same. So let's say that this is the November 8 contracts right now. We're currently Thursday and we're looking for the following week, right? Just for the theoretical example for how you guys can run this. So let's expand the chain. Right? Let's expand the chain right here for Amazon. Oops, this is out of the money. Let's do all the money. So Amazon right here, 165 is where we're looking for, right? As we can see, the 165s pay 44 cents. Now, let's say on Thursday, you look at the following week's chain, November 8th, the same rules apply, right? You'd go down to the 165s and you'd see, okay, how much is Amazon paying prior to earnings? It is paying 44 cents. So there, once again, we do the math. 44 cents divided by our 165 strike, it is roughly 2.6%. Now we time this by 365. How many days to expiry, guys? This is where we have to use a little bit of logic, right? So how many days to expiry at that point? I'm giving you guys a complex one. So in any event, you're doing any of these early in the week, it'll be really easy. We're taking the arguably hardest example of the bunch, right? The rest are going to be easy for you guys. This one, just because it's 1 week further into the future, right? So keeping in mind that on Amazon, we can see here that the days to expiry, right, on Thursday session, you'll be seeing these on the Friday morning. So how many days until next Friday, guys? 7. You include the weekends, right? So divided by 7 right here, times 365 divided by 7, as you can see, it does not respect our minimum 30% ROI. So this one on Amazon, I would have to pass because it just does not respect. There's too many days to expiry. You may as well just wait. And if the stock comes, you may as well just wait on this one. And if the stock comes down after earnings, maybe you just play it after earnings, right? So this one would not respect the before earnings criteria. Let's take an easier one. Let's take AMD that's reporting Tuesday after, right? So let's go for example number 3, which is going to be AMD. So AMD, we identify the large area of support, which is down here 140 to about 128, right? So the expected move on AMD for the week is, expected move for AMD on the week is, let's say it's, 7.3%. So how far away? 156 down to about 145. Once again, $11. 2 times that is $22. 156 minus 22 is 134. So we want to be looking at the 134 strike. Is it in our area of support? Yes, it is. So let's go shopping for an area for these AMD puts, right? So let's pull up AMD. That's not AMD. Let's pull up AMD. So as you can see, AMD down here, AMD, let's expand the chain and look at the 134s. So all the moneyness. So now let's say it is Tuesday, 3 o'clock, 3:30 p.m., and we are looking at AMD. We get a sense of the expected move. We get the area of support. Now we're going to look at the options chain right here. 49 cents for the 135s. Already, this is fairly decent, guys. It's almost, not quite, but getting into the 0.5% range, right? So 0.49 divided by 135, that's your weekly ROI, right? About 0.36% times 365. You'll be looking at these, Tuesday, right? So then you'll have 3 days, 1, 2, 3 days to expiry. So we divide this number by 3, and you'll see this is your annualized ROI, 44%. It does respect our 30% minimum criteria. And if you want to go closer, if you want to be more conservative, you can even drop the strikes a little bit, guys, to get closer to that 30% minimum, right? If this is too aggressive, you can maybe look at the 130, the 130s even, let's say, right? There might be a little bit more there. You know, it might not be enough. We can do the math real quick. Does 130 respect it, right? Let's do it together. 0.25 divided by 130 times 365. Times 365 divided by 3 days to expiry at that point, it'll be 23%. So you'd have to find a midpoint here, but unfortunately there's no 134, 33, 32. So you'd really have to go with the 135s at that point, right? So that is how I play earnings prior to earnings on high conviction stocks that I do not mind being assigned if ever they come down into it. And in the event the stocks rise after earnings, guys, very simple. The next morning, you get to close the trade for almost 100% profit, right? Since we're so far away from the expected move using the 2 times the expected move strategy, we're so far away. If AMD stays flat or goes up after earnings, guys, the contracts that you've written before earnings, they'll be worthless by the following morning. So just take the profits the next morning and look for the next trade. Very, very simple, right? Now, bonus trades number 3 are going to be for some leap call options, guys. And leap call options, I will stress this, very important. Only high quality, high conviction companies, guys. And you guys know best what's a high conviction, high quality company for you, right? Some of you may say that PayPal is a high conviction quality company for you, but compare it to what else we have this week. Microsoft, Amazon, Apple, Google as well, right? So probably PayPal, it may be high conviction, but it's probably not highest conviction, right? So you want the highest conviction trades. And once again, for leap call options, we are going to have to wait for a drop after earnings. So the ones that I'm interested in shopping for, guys, that I'm willing to hold for the next 3, 4, 5, 6 months, because I know the companies are consistent, they're profitable, they're predictable businesses as well, and the valuations on them are relatively good right now. The only leap call options that I'll be looking for this entire week with all of these earnings, guys, are going to be the very following companies. Only 3 companies, actually. Google, Microsoft, and Amazon. And I'm going to be taking these after earnings, guys. So in the event Google has a drop on earnings and comes down into our area of support, right? Let's say they come down into the lower 160. I would even be willing to settle for 160, but let's say 160 down to 155, guys. If they come down into this range, I will be buying leap call options on this stock because I love the valuation, I love the company, and at that point, I will love the price a lot too. So how do we go shopping for leaps, guys? After earnings, okay? So how do I pick my leap options? I'm going for 80 delta in the money contracts. It is arguably the safest way of playing leaps and one of the only ways that I play leaps as well. So what we're going to be looking for here, guys, let's say that Google has just had their earnings and this is their price, right? Obviously, I can't tell you guys what the price of these options will be after earnings. They're going to fluctuate a lot. But let's say for a theoretical example that this is the price of Google after earnings and you like the price, it's come down into our area. What I'm looking for, guys, is the 80 deltas. So the current price is 165. 80 deltas is going to be in the money. So let's see for let's see the 135s. As you can see, the delta is 82. A little bit too high. Let's go one strike up. You can see 79. Perfect. Anywhere between 75 to 80 delta is the sweet spot for me. So I would be looking for the 140 call options with about a year's worth of time. If you want to be a bit more conservative, you can go 1.5 years. You can go with the Junes, but I want to put at least 1 year's worth of time on these because I do believe that Google will be able to maintain this uptrend and expand its business into the next year. And I want to benefit from the most amount of share appreciation as possible. That's why I go with 1 or 1.5 years worth of time on these. Once again, we are looking for the 80 deltas, guys. So now that you know how I go shopping for them, the 80 deltas after the move on earnings happens, right? Here are the areas that I'm looking for. Google, anything below 160. Think 160 down to about 150. That is where I'm looking for. If we gap down and come all the way into here, all the better, guys. I'll be going a little bit heavy, probably 2, 3, 4 contracts on Google at that point in time. Thereafter, Amazon. What I'm looking for on Amazon, guys, is a revisit of the lower 180s. 180 down to about 170, depending how low we come into here. I do not care, guys. I will be loading up the leaps, preferably as close as possible to 175. But if we come down 180, 177, 176, 175, I will be looking to add some leaps here. And if we continue plunging, this is the dollar cost average area for leaps at that point in time. So I'll be looking for the 80 deltas, guys, 180 down to about 170, depending how far we pull back into this zone. I will be looking for leap call options with 1 or 1.5 years worth of time, because I do believe that Amazon is going to complete the breakout beyond $200. The valuation is very good right now, and all of the analyst price targets for the next year are largely in the $200 range. That is stock number 2. Stock number 3 is Microsoft. So Microsoft, guys, is the stock number 3. I love this company. It has been sideways now since the month of January. In the event, I already bought an Amazon leap down here. I showed it to you guys about 2 weeks ago, so I'm already in. In the event, though, guys, we pull back down. Microsoft has an expected move this week of about 5%. If we come down 4 or 5% into this large area of weekly support that has held us up this entire year so far, think 405 down to about 390. If we come into this zone, I will be adding more leap contracts. Once again, going for the $80 strikes or $80 delta strikes, right? But once again, don't forget, Microsoft leap options are a little bit expensive, okay? So they're not for everybody. You can replicate this with call debit spreads, or if you're feeling that type of way, you can use out of the money leap call options for these, but I wouldn't go too far out of the money, guys, like the 470, stuff like that. You want to stay a little bit close, right? So if Microsoft drops here, maybe you go for the 430s, 420s. If you can't afford the 80 deltas, I completely understand, but don't go for the crazy, crazy, crazy strikes all the way up here. They may pay off, guys, but it's still a risky proposition. We have to manage the risk first, right? So, and none of this is financial advice anyways. I'm just telling you guys how I'm going to play it, right? If we come down here, the leaps could be a little bit expensive. We'd be going probably for, at that point, maybe the 365s, 370s, something like that. But you can see these prices, right? For the leaps, let me just put them on. You can see the prices for these 365s. They are expensive, guys. You're talking about roughly, anywhere from, depending on the size of the drop, right? Anywhere between $8,000 to $10,000 a pop. So you really want to be waiting for Microsoft to come down for you, right? No chasing this one if it rises, right? But if it comes down into our area and it's a high conviction stock for you, and you think Microsoft as well will have a good breakout year in 2025 and just continue what it always does, just grinding the levels higher, well, that could be a decent leap opportunity. So hopefully all of that makes sense, guys. I know I gave you guys a lot of different things today, but I wanted to prepare you as best as I can for any case scenario, regardless of what happens. So hopefully you did appreciate the video, guys. If you'd appreciated the video, consider dropping a like. Would really appreciate it for the growth of the channel. Also, consider subscribing if you're new. We do these videos every Sunday evening prior to the week, just to give you guys some prep. And lastly, if you have any questions at all on the strategy, please feel free to leave them down below in the comment section, right? Any part of the strategy, guys, pre-earnings plays, post-earnings plays, leap call options plays, anything you guys want, leave it down below. Now is the time, because we have a ton of opportunities coming up this week. And once again, do not be too greedy, guys. Do not chase the market to the upside. Don't do not write short puts on earnings too close. Even if it's a high conviction stock, guys, please, please, please do not get burned this week. The last thing we want is if the macro unravels, the earnings unravel on us, you go into a 2, 3, 4, 5% correction on the SPY, you're trapped at the top, you have no buying power to buy the dip down here, and you're just upset and currently at a loss as well, right? So be careful this week, guys. And lastly, in the event that you guys are interested in the Discord, as you can see, it was a very nice week for the wheel and for directional plays as well. Here is the results of last week's trading. Here are all of the prior results. You can see the wheel trades, the directional trades. As you can see, well, past performance not indicative of future results, but we do have a very, very high win rate here because we are a little bit more conservative and we're very patient. We wait for stocks to come to us, guys. So that's why and as I've showed you guys on the channel for the past year and a half, Usually these strategies do have a very high win rate if you do them properly. If you're interested in joining the Discord, getting all these plays in real time from me, getting all the different trade setups, guys, the wheel trades, shares and call options, leap call options, shorter duration call options. Discussion is about long-term investments, private live streams every Monday to Friday before the open, and chat with me all day, every day, and ask me all of these questions in real time about your stocks, your portfolio, all of that. The link to the description is always down below. So hopefully I see you guys in there. And if not, we'll have a great rest of your weekend, and I'll see you over the upcoming week, guys. Take care, have fun this week, but also be careful. I'll see you guys tomorrow after the close.